DSCR loans in 2026 qualify real estate investors based on rental income and the debt service coverage ratio, not personal income, W-2s, or traditional DTI. Most DSCR loan programs look for a DSCR ratio between 1.0 and 1.25, 20 to 25% down payments, and a minimum credit score around 620 to 680. DSCR loans often have higher interest rates and prepayment penalties than conventional loans, but they allow faster portfolio growth, LLC ownership, and more flexible underwriting. DSCR financing can be used for purchases, DSCR cash-out refinance, long-term rentals, and short-term rentals such as Airbnb or VRBO properties. This guide focuses on 2026 market conditions, loan terms, and DSCR loan requirements that may differ from 2023 to 2025. If you want DCR loans explained for 2026 without lender jargon, the main idea is simple: the property needs to pay for itself. That makes DSCR financing useful for investors whose personal income is hard to document, whose tax returns are optimized, or whose portfolio has outgrown conventional financing. What is a DSCR loan in 2026? A DSCR loan, or debt service coverage ratio loan, is a specialized, non-qualified mortgage real estate loan designed for property investors. It is a type of non-qualified mortgage designed specifically for investment properties, qualifying borrowers based on the property's rental income rather than personal income. In plain English, loan approval depends on whether the property's rental income covers the mortgage payment and related housing costs. DSCR loans qualify borrowers based solely on the property's rental income relative to its debt obligation, while conventional loans require personal income documentation such as W-2s and tax returns. Instead of analyzing W-2s, personal tax returns, the borrower's personal income, or monthly debt obligations, DSCR lenders review the property's ability to cover principal, interest, taxes, insurance, plus HOA fees when applicable. That full payment is commonly called PITA. DSCR loans are specifically designed for investment properties and are not available for primary residences, which distinguishes them from traditional mortgage products. They are also classified as business purpose loans under federal lending regulations, which means they are exempt from many consumer lending rules that apply to owner-occupied home loans. Investors can hold titles directly under an LLC or corporation for better asset protection when using DSCR loans. Typical use cases include buying a turnkey rental property that already has stable monthly rent, refinancing existing rental property investments, using a cash-out refinance to pull equity from a stabilized asset, financing Airbnb, VRBO, and other short-term rental strategies when income is sufficient. How debt service coverage ratio is calculated. The debt service coverage ratio is the core metric behind every DSCR mortgage loan. In residential investment property financing, it measures whether the property's monthly rental income is enough to cover the monthly mortgage payment and PTI. The standard residential formula is DSCR equals monthly gross rental income divide monthly PITAA. PITAA equals principal plus interest plus taxes plus insurance plus HOA fees. The debt service coverage ratio, DSCR, is calculated by dividing a property's gross rental income by its annual debt service, which includes principal, interest, taxes, insurance, and any applicable association dues, PITA. On a monthly basis, the math is the same: monthly rent divided by monthly PITA. Some investor spreadsheets label this annual mortgage debt, RDP, or annual debt service. For example, monthly gross rental income $2,400, monthly PITIA $1,900, DSCR 1.26. In this example, the property generates 26% more income than it needs to cover the required payment. A DSCR of 1.0 means the property's rental income exactly covers its debt obligations, while a DSCR above 1.0 indicates that the property generates more income than it costs to carry, which is generally considered favorable for loan approval. If the DSCR ratio is below 1.0, the property's rental income does not fully cover debt service. That does not always mean the deal is impossible, but it usually means higher rates, lower loan to value, or a bigger down payment. Commercial DSCR math can look different. Larger commercial or multifamily loans often use net operating income divided by annual mortgage debt, usually focusing on principal and interest rather than the full residential PITAA structure. For those deals, lenders may also study the property's net operating income in more detail. On a residential DSCR loan, however, lenders are not underwriting the borrower's net operating income. They are focused on property income and rental cash flow. For a vacant or newly acquired rental property, many lenders use an appraiser's market rent estimate, often through a rent schedule such as Form 1007. That means the property's rental analysis may be based on market rent instead of an existing lease. DSCR loan requirements in 2026. DSCR loan requirements are stricter in 2026 than they were in the early 2020s. Higher rates, insurance costs, and vacancy concerns have made most lenders more careful about the property's expected cash flow. Here are the main qualification pillars. Minimum DSCR. Most lenders require a minimum DSCR of 1.0 to qualify for a DSCR loan, meaning the property's rental income must at least equal its debt service costs. Most lenders require a minimum DSCR of 1.0 to 1.25 for loan approval, meaning the property must generate at least enough cash flow to cover its annual mortgage debt, with a buffer for unexpected expenses or vacancies. Credit score. Most DSCR lenders require a minimum credit score of 620 to 660, with scores of 700 or above unlocking better rates and terms. Many programs technically start at 620, but most DSCR lenders price more aggressively once the borrower's credit score reaches 700 to 740 plus. DSCR loans generally require a down payment of 20% to 25% of the property's purchase price, with some programs allowing as low as 15% for highly qualified borrowers. Standard purchase scenarios often cap loan to value around 75 to 80%, while cash out refinance, short term rentals, or lower DSCR ratios may receive lower LTV limits. Reserve requirements commonly range from 3 to 12 months of PITAI in liquid assets. Lending frameworks for DSCR loans have expanded, allowing for the use of alternative assets toward reserve requirements, but insufficient reserves remain a common reason a property qualifies on paper but fails underwriting. Borrowers must provide documentation such as current lease agreements, property appraisals, and financial statements to demonstrate the property's income-generating potential and their ability to manage cash flow. If the property is vacant, the lender may lean heavily on market rent and the appraisal. DSCR loan terms in 2026 are shaped by a higher interest rate environment and lender risk appetite. What makes DSCR loans flexible is also what makes DSCR loans more expensive. The lender is approving the deal without traditional personal income verification. Common loan terms include 30-year fixed-rate DSCR mortgages, 5/6, 7/6, or 10/6 adjustable rate mortgages, 40-year options in some programs. DSCR loan rates in 2026 vary widely. Strong deals may price in the mid 6% to low 7% range, while mid-tier scenarios can land in the 7.25% and 8.5% range. Rate data changes quickly, so investors should compare live quotes rather than rely on averages. For general market context, investor-focused rate ranges are tracked by DSCR lending resources such as DSCR Check. Risk-based pricing usually gets worse when DSCR is below the lender's preferred threshold, LTV is high, credit score is weak, the deal is a refinance rather than a purchase, the property is a short-term rental, non-warrantable condo, or mixed-use property. Many DSCR loans include prepayment penalties because they are business purpose, non-QM products sold into investor markets. A common structure is a 5-year step-down penalty such as 5, 4, 3, 2, 1%, or a 3-year structure such as 3, 2, 1%. DSCR loan programs in 2026 are designed for income-producing residential and small multifamily real estate. DSCR loans are available for various property types, including single-family homes, 2 to 4 unit small multifamily properties, and small balance multifamily of 5+ units. Common eligible properties include single-family rentals, duplexes, triplexes, and fourplexes, condos and townhomes, small multifamily properties up to 10 units with some lenders, mixed-use buildings where residential income is strong. For long-term rentals, the lender usually reviews the current lease, a 12-month lease, or the appraiser's market rent. If the property is vacant, the lender may use a market rent schedule instead of actual property income. DSCR loans can be used for both traditional long-term rentals and short-term rentals, such as those listed on Airbnb, provided the rental income is sufficient and stable. Short-term rental (STR) income is treated differently from long-term rental income by most DSCR lenders, often requiring at least 12 months of documented short-term rental history to qualify based on actual income. Heavy fix and flip projects usually do not fit a DSCR loan at the start. Investors often use a bridge or rehab loan first, then refinance into DSCR financing once the property is stabilized and rent-ready. A DSCR cash-out refinance lets an investor replace an existing loan with a new DSCR loan and pull equity from the property. DSCR loans can be used for refinancing rental properties to obtain a lower rate or to pull equity from a stabilized asset, commonly referred to as a cash-out refinance. This became a core tool for BRRRR investors by 2026 because it allows them to buy, rehab, rent, refinance, and repeat without relying on personal income for every new loan. During the refinancing process, lenders assess the property's current rental income, cash flow, and market value to determine the new loan amount and terms. A strong DSCR can lead to more favorable refinance options, such as lower interest rates and higher loan-to-value ratios, enhancing the property's expected cash flow and overall portfolio performance. The refinance recalculates DSCR using the new loan balance, new rate, taxes, insurance, and HOA fees. If rates rise or taxes jump after renovation, the new debt service can tighten the ratio. Cash-out refinances on DSCR loans have a seasoning requirement when the loan amount exceeds what the investor originally put into the deal, typically requiring a 6-month waiting period from the original purchase date. Some lenders also require 12 months of rental history for more complex files. DSCR loans versus conventional loans. DSCR loans and conventional loans serve different borrower profiles and goals in 2026. The fundamental difference between DSCR loans and conventional loans is that DSCR loans do not require personal income documentation. Instead, they assess the property's ability to generate sufficient rental income to cover its debt obligations. Conventional investment property loans rely on personal income, tax returns, W-2s, employment history, and debt-to-income ratios. DSCR loans work differently. The lender looks almost exclusively at rental income and the debt service coverage ratio, DSCR. Here's a simple comparison. For underwriting, DSCR loans use rental income and DSCR, while conventional loans use personal income and DTI. For documents, DSCR loans are low doc, usually no W-2s or personal tax returns, whereas conventional loans require full income verification. Borrower fit for DSCR loans are investors, LLCs, and self-employed borrowers versus W-2 borrowers with clean DTI for conventional. Portfolio scaling is flexible across multiple properties for DSCR, but often limited for conventional. Conventional loans typically limit borrowers to financing 6 to 10 properties, whereas DSCR loans do not have a portfolio cap, allowing investors to scale their portfolios more freely. Pricing for DSCR loans means higher rates and fees, usually lower rates for conventional. Prepay penalties are common for DSCR, but less common for conventional. That said, individual lenders can still apply exposure limits, reserve requirements, or portfolio-level reviews. Choose conventional financing when you have strong W-2 income, clean DTI, and only a few properties. Choose DSCR financing when personal income is complex, tax optimized, or when you want to scale rental property investments through the property's cash flow.